Okay. So let's get to closing entries. So remember, our whole function as accountants is to record transactions, and then at the end of the period to create these statements. So when we get to the end of that period and we've made our statements, now we have to prepare for the beginning of a new period. And what that requires us to do is to return some accounts back to zero, those accounts which measure change over the time period, and then convert that into a more permanent account. So they actually use the terms temporary accounts and permanent accounts. And by temporary, we mean those accounts, temporary. We mean those accounts that we need to reset to zero each financial period, okay? I'll tell you, it's interesting is that's really going to involve our revenue accounts, our expense accounts, and our dividend accounts. Those are the temporary accounts. Another term you might use for these accounts is income statement accounts, revenue and expense, right? So if we go all the way back to our income statement, skip all the way back to it, we're going to see that the time period measured by the income statement is for the 2 months, on this case, ended December 31st, which means the income statement measures balances over time, okay? But the balance sheet's not going to say that. It's going to say as of December 31st. So I want you to think about that. Balance sheet accounts, assets, liabilities, stockholder equity, they are a balance as of a given day. What's the balance of this account? It's whatever the balance is today. Revenue and expense accounts are, well, how much revenue did we make during this period? How much expense did we pay or incur during this period? So the temporary accounts, because they measure something over time, when we get to a new time period, we have to return them back to zero. But the non-temporary accounts, they're going to maintain balances. Okay, so closing is the process that we use to close out these accounts. If you can't remember my explanation I just gave you as to what's different between temporary versus permanent, then at least just remember the accounts you're going to have to close are revenue, expense, and dividend. Okay. So here we have a process whereby we have to close them. So expense accounts at the end of the period are always going to have a debit balance in them. Why? Because that's the normal balance in an expense account. So the way to close the account would be to credit the account the amount of its balance, leaving the new balance as what? Zero, right? That's, I mean, kind of obvious. So to close our expense accounts, what we're going to do is we're going to, remember they all have balances on the debit side. We're going to credit those accounts. Now there's something going on here, and is we can't really credit these without debiting some other account. Okay, so what's happening is we're creating a special account just for the closing process that we call the income summary account. Okay, and it's also temporary. It's going to be immediately returned back to zero. So here they show it just as going into this total revenue, total expenses. But if you think about it, what we're doing is creating this special account. We're crediting all of these expense accounts so that we can bring their balance to zero. And if we're doing a credit here, then what do we have to do somewhere else? A debit, right? Like, so we're going to debit $9,855 to this special account. So now we've effectively closed all the expense accounts, but we've opened this new temporary account just for a moment, okay? Then we're going to look at our revenue accounts. We had two of them, if you remember. One was fees earned, the other was rent revenue. They both had credit balances because credit balance is the normal balance for a revenue account. So to close those, we're going to debit the account. So fees earned will debit $16,840. The new balance of that account will be zero. Closed. Back to zero to start for a new period. Rent revenue, $120. So we will credit, if we're debiting those accounts, we'll credit the income summary account, $16,960. The new balance of the income summary account then will be $7,105. So let me ask you this. Where have we just seen these numbers? Ever remember? On the income statement. So this represents our total expenses. This represents our total revenues. So this represents our net income. Okay? We would expect that. Now, what happens to net income? What account does it affect? Right. So to close income summary, it has a credit balance of 7105. We'll debit income summary 7105. We'll credit retained earnings 7105. We've now moved the temporary accounts of revenue and expenses momentarily to a temporary account called income summary, and from income summary to retained earnings. And now we've closed the temporary accounts. They all have balances of zero, and the only account that still has a balance from that activity is a permanent account. That's what closing means, okay? So we're taking the temporary accounts, revenue and expense, and then dividends, and we're closing them to retained earnings. And by closing, we mean we're taking their balances down to zero and putting them over to retained earnings. Dividends has a debit balance of 4,000. Why? Because that's the normal balance for dividends. So to close dividends, we'll credit it 4,000, and we'll debit retained earnings 4,000. So revenue and expenses close to income summary for a moment. We get the balance, and then we close that balance, which is net income, straight to retained earnings. And then dividends, we just close straight to retained earnings without the income summary. Okay. So retained earnings will get 4,000 here. And the new balance. If you think about it, this is just all the information that was just summarized on the income statement and the statement of stockholders' equity, but the sort of accounting language side of it as opposed to the report side of it. So we do the report so that the layman, right? In my case, the director of our board, who is she has a medical practice with her husband. She's not an accountant. So I put it into these reports so it's easy for her to see the summary, right? But I know that underneath, this is really what's happening, is we're taking all these accounts back to zero so that we can start the new period. Now, on day one of the next time period, revenue is zero. So any revenue we start to earn during that time period will accumulate in my revenue accounts. Any expenses we incur will accumulate in the expense accounts. So this is called the closing process, okay, or just closing entries.